welcome to today's Explainer, where we're taking all those overnight geopolitical shockwaves and bridging them directly into concrete, actionable, technical setups. If you're a market participant trying to navigate the absolute volatility we saw yesterday, and you want to map out today's most crucial levels, well, you are in the exact right place. Let's get into it. $115 billion. Let that sink in for a second. That is the staggering amount of market value that was literally wiped out from Indian markets on Tuesday, as gravity just aggressively took hold. It was a brutal session. And to understand exactly why this happened, and more importantly, where we go from here, we've got to connect the dots across the entire global landscape. So here is our quick roadmap for today. First, an overnight global macro overview. Second, geopolitics and energy markets. Third, global currency technicals. And fourth, we'll break down that Indian market sell-off. Kicking things off with Section 1, our overnight global macro overview. Okay, the absolute biggest headline grabbing everyone's attention right now is that U.S. inflation is heating up again. Hotter than expected, US CPI just hit 3.8% for April, which, by the way, is the highest reading we've seen since May 2023. This jump was largely driven by surging energy costs linked to the ongoing conflict in the Middle East. Now, this data point is a real game changer because it has severely weakened expectations for Fed rate cuts this year. It's actually reviving whispers of future rate hikes. Even safe havens like gold slipped because of this. Over in equities, U.S. markets closed mixed. The Dow managed a modest gain, but the Nasdaq fell, mostly weighed down by some real weakness in semiconductor shares. You'll definitely want to keep this timeline handy today because these key data releases are going to act as immediate catalysts for volatility. We're watching Eurozone GDP and industrial production data this morning, followed by the highly anticipated IEA and OPEC monthly reports midday, and then we round it all out with the absolutely critical US PPI inflation figures this afternoon. Moving right along to Section 2, geopolitics and energy markets. With Gulf tensions simmering and any hopes of a US-Iran peace deal rapidly fading away, Brent crude absolutely refuses to cool down. I mean, it's behaving like it's had 3 energy drinks too many, holding really strong above $107 per barrel. On the diplomatic front, Donald Trump is visiting China to formalize trade and military agreements, and he's explicitly noted that Washington doesn't need Beijing's help with Iran. At the exact same time, regional tensions remain super elevated, with Kuwait accusing IRGC members of hostile activity near Bubiyan Island. All of this geopolitical premium, it's exactly why oil producers are kind of quietly enjoying the chaos right now. All right, Section 3, global currency technicals. Let's look at the charts. Let's kick this off with the US dollar index, or the DXY. The dollar strengthened for a second straight day as investors sought safety and that hot CPI print pushed yields up. However, looking at the technicals, the structural trend actually remains a sell on rise, albeit with pretty middling momentum right now. For your setups, you want to watch resistance overhead at 98.60, with your downside support sitting firmly at 98.17. Now here is the really fascinating part. Look at the dramatic shift in probabilities we saw overnight. Fed funds futures are now assigning a roughly 30% probability of a rate hike by year end. That is a massive jump from the 21.5% we saw just before the CPI print. This makes today's US PPI numbers absolutely critical for testing that DXY support we just talked about. Okay, shifting over to the euro, the pair eased off just a bit to find initial support around the 1.1730 level. Structurally, this technical setup remains a buy on dips. Immediate resistance is positioned up at 1.1780, and hey, if we happen to break current support, the next major level lower sits at 1.1688. The soft points driving the euro right now are super compelling. The ZEW economic sentiment prints actually showed some surprising resilience, falling way less than markets had expected. But keep your eyes peeled today because market participants are expecting a completely flat GDP growth print out of the Eurozone. We've also got French CPI and Eurozone industrial production numbers dropping, which are going to be your primary catalysts for testing those euro levels. Turning to the British pound now, it faced heavy pressure for most of yesterday's session. Technically, the setup stays as a buy on dips, but, and this is a huge but, there is absolutely zero momentum backing it up right now. Your key resistance is at 1.3558, and strong support is down at 1.3476. And this setup brilliantly illustrates exactly why the pound has zero momentum today. The 10-year gilt just broke above 5.10%, and the 30-year yield is hitting levels we literally have not seen since March 1998. The bond market is flashing a very clear, very sober reminder here. Convincing markets that fiscal stability will continue is absolutely crucial if they want to avoid repeating that 2022 Liz Truss moment that pushed UK pensions right to the brink. Heading over to Japan, as global risk sentiments sour, the yen just continues its steady weakening. This keeps the USD-JPY pair strictly a sell-on rise on the charts. Your immediate resistance is sitting right at the 21-day moving average of 157.78, followed by 158.35. Support is currently pegged at 157.31. So the crucial point you need to understand here is highly political. The Japanese 10-year bond yield has hit 2.58%. It feels like a lifetime ago that markets were stressing over a mere 2% break. Prime Minister Takaichi's nomination of dovish Bank of Japan board candidates is a very deliberate political choice. It's timed perfectly to protect corporate margins and avoid mortgage pain right ahead of their upper house elections. And finally, Section 4, the Indian market sell-off. This is where we actually break down that initial $115 billion wipeout we talked about earlier. The Nifty 50 fell 1.83% to close at 23,379.55, and the Sensex dropped 1.92%. That marks their worst session in 6 weeks. Mid-caps and small caps, they bore the absolute brunt of the hit. Sector-wise, IT stocks led the losses on some very genuine fears that rising oil could put a serious dent in global growth. And in the bond market, the 10-year yield rose to 7.0458%. Why did that happen? Well, skyrocketing crude prices completely overshadowed any relief we might have felt from India's April CPI data, which edged up only slightly to 3.48%, sitting nicely below the 3.8% expectations. This macroeconomic strain from energy, it is incredibly real right now. Prime Minister Narendra Modi is directly urging citizens to reduce fuel use, travel, and non-essential imports. He is essentially asking the country to treat their foreign exchange reserves like a highly prized, limited edition collectible. Technically speaking, the Nifty opened lower yesterday, briefly tagged 23,757, which ended up being the high of the day, and then just made a relentless, one-way move down. It formed a pretty brutal long bearish candle, with zero meaningful absorption on the way down, extending its lower high, lower low structure for the third consecutive session. The view definitely remains a sell-on rise. Watch for overhead resistance at 23,576, with supports clustered at 23,260, and further down at 22,928. Over on the currency side, the rupee dropped 0.33% versus the dollar. Fading peace deal hopes sparked a massive run-up in oil, which, combined with persistent portfolio outflows, heavily pressured the currency. However, the chart shows us it's actually not overbought yet, keeping the tactical view firmly as a buy on dips. The next target higher is 96.18, with robust supports waiting for you at 95.43 and 95.21. What's particularly fascinating to watch on the Asian currency landscape right now is this incredibly sharp divergence. On one side of the coin, you have a struggling rupee dropping to an all-time low of 95.7375 right before RBI intervention likely stepped in to steady the fall. But then right next to it, you have a surging Chinese yuan that literally just hit a 3-year high. It is a tale of two vastly different structural realities playing out in real time. Which brings us to the ultimate question for all of us trying to navigate these turbulent markets today. Are global inflation pressures genuinely broadening across the system, or is the market simply pricing in a temporary, geopolitically driven, oil-powered upgrade? You really need to keep that question front of mind as today's data from Europe, the US, and the oil cartels rolls in. Because honestly, the answer to that exact question is going to decisively dictate the next major shifts across every single technical level we just went over. Thanks for joining me on this explainer. Keep your eyes on those charts, stay super disciplined with your setups, and I will see you in the next one.